Can you share with us or can you explain us more about implied volatility? I do trade in implied volatility by writing options when the IVs are historically high. But it's a technical question, but Asad, you get the point. Can you explain us a little bit more about this?
Yeah, so implied volatility, so what, I should probably back up a little bit so we can understand this. So
Yep.
there's a famous pricing model called the Black-Scholes option pricing model, which is widely used by most people who trade options.
Mm-hmm.
And it essentially gives you the price of the option as your output, and your inputs are sort of, say, the current stock price, the current commodity price, current interest rates. And one of the inputs is the current volatility.
Mm-hmm.
So the price of the option depends on the current volatility.
Mm-hmm.
So now the volatility is something we don't observe because we don't exactly know how much. We can look at historical volatility, but we don't know what the future volatility will be.
Mm-hmm.
So now implied volatility, what it does, it just takes the Black-Scholes equation and sort of solves it for volatility. So rather than inputting volatility and getting a price, we just look at the current price and then say, well, what would the volatility be if this was the current price? So it's the volatility that's implied by the current price.
Mm-hmm.
So the current price is sort of pricing in a certain level of volatility.
Mm-hmm.
And this volatility is measured on an annual basis. For those of you who've done some statistics, you will know, it's just the standard deviation over a 1 year period. So you may have a volatility, say, of 20%, mm-hmm. which means that, it assumes a normal distribution. So it means that, 68% of the time you will have the asset in question will move up or down by within 20%. Okay. So now options are always long volatility. So if you own an option, you're long volatility. If you write an option, that is sell an option, you're short volatility. So in response to the second question, whether you can write options to take advantage of high implied volatilities, yes, of course, that's a very doable strategy. I think for people who want to write options, so in this case you'd be short volatility, you'd expect it to fall. It's obviously much more tricky because the potential losses are unlimited. You're the other side of the option. So whereas if you own an option, the potential losses are limited. When you write one, they're unlimited. So for that reason, it's a lot more risky. But because you're taking on all that risk, there's a good chance you can make a profit too. So I would say yes, it is possible to do that. I think it depends on, you need to have a lot of capital as well, because normally brokers will not let you write options unless you have a lot of cash in which you have, if the option if you had to pay out, you would be able to do it. So again, that's for someone who's kind of like, who's a little bit more experienced, who has a bit of cash. But yeah, it can be a very profitable strategy. It's done a lot by, big investment banks and hedge funds and things. So, yeah.